Hello, everybody, and welcome to our discussion on personal finance, specifically with the credit reporting and scoring, understanding both the credit report and the credit score. So, now I wanted to talk about the actual components of the credit score. This is what you probably clicked on this YouTube video to really look at. Now, I also want to mention that this percentage breakdown, it's not going to be identical for every specific model. They all have their own breakdown, but this is a pretty standard one, give or take a few percentage points. So the five main items that impact your credit score. The biggest one by far is your payment history, and that's what you're probably already familiar with. I'm just going to say it's a 35% right on average. We'll talk about each of these in detail in the next few minutes as well. Credit utilization. So, what percentage of your credit limit are you using? 30% there. The length of credit history or your average account age, that's a little bit less, it's 15%. And the fourth one may seem a little odd, but new credit or seeking credit, 10%. It's not a very big item, but it still does hurt you if you're out there searching for several different credit cards, for example. So all of a sudden, if you've opened up 10 new credit card accounts in the past month, that's going to have a hit on your credit score, and that's going to ding it a little bit. So be very careful when you go into some of the retailers and they say, hey, would you like to sign up for a credit card? Unless you really think you have a need for that credit card, or if there are really some benefits that you think will benefit you, I would say decline it, because that's going to hit your credit score. Maybe not in a huge amount, but every little bit counts. So don't just open up credit cards just for the heck of it. Make sure there's a need for it and you've thought it out. Credit mix or types. So this one you might not even be aware of, but basically they're saying, what types of credit do you have? If your entire credit history is just a bunch of credit cards and that's it, that's not going to look as good as it would as if you had some credit cards, a car loan, maybe an installment loan, a home loan, student loan. The more diverse your credit history is, the better your score will be. Now, again, that's only 10%, but again, every little bit counts. The idea there is that when you have a broader history, that lender sees, hey, apparently they're financially responsible. They've had relationships with different types of lenders. They've handled them well, so I feel more comfortable lending to them. Now, I want to mention, just as a disclaimer, all of these percentages are just estimates. The weighting may change depending on the model of the score you're looking at. So now let's dig into each of the different components in more detail. So payment history, 35%. Again, the credit reporting agencies only know about accounts that go 30 days or more past due. I want to point that out because that's handy to know. There might be situations where you accidentally forgot the due date, you're a few days late, and yes, with that lender, especially if it's a credit card or something like that, there's probably going to be a fee. You might be able to get them to waive it, or maybe not. So with that lender, yeah, it's not good to be late, but if things do go late, if you need to wait till payday to pay or something like that happens, things happen in life. Everybody understands that or should understand that. But what I want to point out here, as far as your credit report or score, please make sure it doesn't go 30 days or more past due. That's when it's going to hit your credit report. If you happen to have had accounts that are 20, 25, 29 days past due, they will never make it to your credit score. They can't. So that's a good thing, at least. It gives you a little bit of a grace period. It doesn't mean it's not going to hurt your relationship with that one creditor, but at least it won't show up on your permanent credit score record. So 30 days or more, and by the way, I do mean 30 days. So it's not always the same as a month. Some months are 31 days. One of them's 28 or 29 days, February. So count the actual days, and on day 30, that's when it could be reported. So be very careful in your counting. 60 days or more hurts the score even more. You really want to try to avoid the 60 days or more because these things could stay on your record for 7 years. Generally, they have an impact for about up to 2 years, and then after 2 years, they become significantly less important to any future lenders and significantly less important in your score. So things do get better. Time does heal the credit score as long as you're improving your financial accounts. So this is the payment history. It's also the percentage of accounts that are always paid as agreed, the length of time since the last payment on any account, and what I want to throw out here is that if you have a collection, try to avoid those at all costs. A lot of times companies will wait sometimes 90 days, but more often like 120 or maybe even 150 days before they send something off to a collection agency. Try to work with that creditor. Pay whatever you can. Set up a payment plan. Really try to avoid the collections. And of course, derogatory public records would take that to an even greater step. This is where they filed a lien against you. They have a judgment against you. Those go on your credit report, and they have a huge impact. They're a big blemish that's very hard to come away from. So just try to avoid those at all cost. Credit utilization. This, I will mention, is one of the things you have the most power over. This has 30%. It considers the number of accounts with balances. Now, I want to underline that or really focus on that with balances. Having a bunch is not necessarily good, but having some is good. So I'm going to throw something out here that may seem completely counterintuitive. Don't close your accounts without thinking about the potential impact on your credit score. And I will also throw out, don't pay all of your accounts down to zero all the time. Now that seems very odd. It seems like zero is a great balance, but zero is an inactive account. Pay it down to $5. Charge one of your meals on it each month and then pay the balance off. That's fine. You get paid off at the end of the month, but then put a few bucks back on it so that when it gets reported, it has a balance, but a small balance. If it's reported as zero, it tends to reduce the impact of it on your credit score and your credit report. You'd think that, hey, this is a great thing to have zero credit due, but no, that's not necessarily a good thing. You know, on that same note, I'm going to throw another thing that seems odd out. Some people go down the path where they say, hey, I don't like having credit at all. I like paying for everything in cash. If they are fortunate enough to be in that situation, I would argue that in this day and age, that's not necessarily a good thing because you never know when you're going to need to borrow money. If you go through your life and you pay for everything in cash, again, you've had a great job, whatever, you pay for everything in cash. Yeah, it's nice not having debt, but the problem is 5, 10, 20 years later, now you need to borrow money for a new house or student loan. You're not going to be able to. You have no credit history. So that's the problem with it. I would say the better approach is to get a reasonable amount of credit, whether it be a small car loan, small credit card, whatever, and then manage it well. That's the best way to work this. So the utilization here is the big thing. It considers the total revolving debt, like credit cards generally, divided by the total revolving credit limits. So if you have $100, or let's say you have $1,000 credit limit, and you've used up $900 of that $1,000, you have a 90% utilization. That's not going to look very good on your credit score. To be the best there, they want you to get your credit utilization down below about 7%. So yeah, you might use your credit card, but then pay it really low by the end of the period before they report that credit card. That's the best. So again, don't necessarily pay it to zero, but pay it very close. Increase your credit limits when you can within your level of responsibility. So think about yourself. Will you be able to handle the situation when you have a high credit limit, or will you be tempted to spend it? Now, that temptation's out there, So you really have to think about your own situation, understand yourself there. I just want to be cautious with that. Some people can fall into a trap where they're tempted. They get this, $1,000, $2,000 limit, and they may be tempted to go buy stuff. Again, no judgment whatsoever. Every person has their own things to deal with, but just pay close attention to that. Consider yourself. But the credit limit being higher as far as your score goes will be better. Also, don't have any individual account over the credit limit or really even close. So let's say you have 10 accounts, which that's a little high, but let's just say there are 10 accounts there. 9 of them are paid down to near zero, but then you have one of them that you maxed out or it's over the limit. That's still going to have an impact on you. Yeah, it's not going to be as big of an impact because your overall utilization is probably low, but you don't want to see any of those red marks where it's over limit or close to it. So the ranges that generally matter here are when it's below 90. You want to get these. First of all, below 90%, that'll help you quite a bit. But then below 70% is the next, or is even better. Below 50% is even better. Then 30%, that'll take you to the next level. And ultimately below 7% is where you want to target. If you're trying to improve your score to as good as you can get it, that's what you need to do. Now, what I want to mention here, which we'll see a little bit later, is this can update on a very regular basis, depending on when your credit card or when your loan reports to that credit reporting agency. So you might have in a perfect situation, if you knew exactly when your credit card company reported to the agency, if you made a payment one day, and then let's say 2 or 3 days later they report to the credit reporting agency, it's going to show up on your credit score in 3 days. So there's not an intentional delay on the impact. It's all about when things are reported. You could have a situation where, I guess in a crazy example, you have, let's say those 10 credit cards, or let's just say 10 credit cards, and they're all 90%. They're all way up there. Let's say they all report on the same day. So somehow, maybe you get a debt consolidation loan, or maybe you are able to find money. Maybe you get a bonus from work, and you pay those debts down right before they report to the credit agency. You might see a drastic increase in your score in just a couple of days' time. So you might be able to time that perfectly where that works to your advantage. The length of your credit history, or the average account age. So again, this looks at the age of the oldest account. Hopefully that's very old. The older the better. You want to keep those old accounts open if at all possible. It looks at the age of the newest account, which you don't really want a bunch of new accounts. That hurts your score. And then it looks at the average age of all accounts, which obviously if more of your accounts are older, your average age is going to be better. To improve this component, close the newer accounts unless there's really a good reason to keep it open. Close the newer account, but if at all possible, do not close your older accounts. If you've had an account out there for 10 years, keep it by all means. You might not need to keep a balance on it. Let's say it's a credit card. You don't need to keep a balance. Maybe it has a bad interest rate or it just doesn't do you any good. Keep it out there. Keep the payment or keep the balance down to near zero, but again, not necessarily zero. Try to keep $5 on it or anything to report it so that they report it every month. Some of them will not report at inactive accounts, and in fact sometimes they'll close the inactive account if you haven't used it in 6 months or a year or whatever. And the other component here, or one other component, is the new credit or seeking credit. So if you open several new accounts in a short period, that's going to hurt your score. Even applying for new credit hurts your score. Now, I will mention here that they supposedly can tell if you're out there searching for the best rate for a mortgage or for a car loan. So maybe you have 10 hits, but it's all for the same thing. It supposedly only counts against you one time instead of 10 times. Now, there's no way to prove that, but that's what they say. On the other hand, credit cards are basically treated as a hit every single time. So be careful with that. Now, they generally, as far as this element goes, they generally just consider the past year, maybe up to 2 years. So it will quickly fall off your report. And again, it's only a 10% impact anyways. But just be careful with this. Don't go apply for anything and everything because it will impact your score a little bit. And then I think I talked about the last one quite a bit already, the credit mix or types. It's better to have accounts in all categories rather than just one or two. Now, I'm not saying go out there and get debt just for the sake of getting debt, but if you have them, it's gonna help benefit your score a bit. So home loans, car loans, installment loans, that's kind of one category there. Bank issued credit cards, and there might be other revolving accounts. If you have something in each of these categories, that little 10% of this credit score is going to be improved. But again, if you close the account, it falls off. It no longer benefits you at all. So the last few slides I have here are little tips on how to improve your credit score quickly. Now, I'm not by any means offering any magic tricks. A lot of times you'll see those on television ads that, hey, we can fix your credit report. We can erase stuff from your credit report. Legally, the only thing they can do is remove things that are improperly reported. There's no legal way of eliminating things that might be bad, but they're legitimate. So what I'm showing you for these tips are things you can do within the rules to try to improve your score fairly quickly in some cases. So the first step here is, again, scan your credit report, identify any erroneous accounts or payment histories, and dispute them through the ways that I talked about earlier. As I said a bit ago, if you have any newer accounts that you don't need, feel free to close those. Now, unless they're in one particular category, like the installment loan or the revolving account, and it's the only one in that category, then it's kind of a toss-up as to whether it's best to close it or leave it open. And again, do not close the older accounts. It seems counterintuitive. It seems like you'd rather have it completely off to show I paid successfully and I'm done. It's not a good idea. It's counterintuitive, but do not close the older accounts. It doesn't matter if it had a bad history or a good history. When you close it, it's not going to help your age. Now, the interesting thing is that once that account is closed, let's say you paid for 20 years on that account with a perfect record. Once you close that account, it's like it never existed. That 20 years of positive payment history doesn't matter one bit after you close it, which is so frustrating. It seems very unusual, but that's the way it works. However, oddly, any negative impact remains. If you close the account, and let's say you did have a string of missed payments, it is still going to count against you in a bad way, but it won't help your age. And the age is one of the things you want to try to improve. Now, in some cases, you might be able to increase the credit limit with the company without even counting as a hit. So it's hard to know whether it's going to impact your score, whether it's going to actually count as an inquiry or not. Different companies do it differently. Certainly pay down any over limit accounts. Do that right away, and then within 30 days, hopefully less, you'll see the benefit there. And as I said, you definitely want to start by paying them all off if they're over limit, or pay them down so they're not over limit. But then you want to work on paying the accounts down below one of the aforementioned thresholds, hopefully below 7%, but at least get it below 90, and then shoot for the 70 and then the 50. The average, that's what I'm saying, the total utilization, get that below 50, 37. So that's what we're saying there. And then finally, I just wanted to mention here that you want to identify when at all possible when your company reports their balances to the agency. So some of them take the statement date and then they report a few days later. Some of them, there might be a longer delay. But the best thing to do is look at your credit report detail to try to get an idea on a month-to-month basis when your account is updated each month. Now notice in this example, the screenshot, this one was updated September 9th, so not that long ago. If I was to look at next month, it's probably going to say October 9th or very, very close, depending on what weekday it falls on. So now I know by September 9th or by October 9th, I want to get my balance to a certain point before it reports. Also, notice this is an example of the tip I said earlier. Don't pay it down to zero. Pay it to $1, $5, something like that. That's fine. Just have some balance. Now, if you know what that reporting date is, you might be able to pay an account down and have a very quick impact. If I paid this on September 8th, or let's say September 7th, and maybe this was a, I don't know, $5,000 amount, and I paid it down to $1, that's going to have an extremely quick impact to your credit report and your credit score. Now, one tip here I will say, use this with discretion, but if you're working toward a mortgage or a car loan and you know you're going to be able to pay some of your accounts down, but you need to do it quickly, you need to have a quick impact, you can dispute the balances. Let's say you don't think it's going to report, maybe you missed September 9th. I paid this on September 10th. You don't really want to wait till October 9th. You can dispute the balances to accelerate the impact. It may accelerate them. It doesn't always work. But again, you don't want to do this all the time. Do this if you really need to improve your score for an upcoming loan, car loan, mortgage, and you can't wait 30 days. You might see a benefit from doing this. So again, dispute it through one of the online portals, possibly by sending them a letter in the mail, and they'll check with the agency and they'll say, yeah, here's your updated amount. That might work, it may not. It's just a tip to use, to consider. So hopefully this has helped out. This is actually the first video in the personal finance section of this series. A lot of times I post financial and managerial accounting videos, but I decided to start some of these as well. So hopefully this has helped. If you'd like to check out some of the other videos I have, you can either use one of these links or just type in Severson Accounting YouTube on Google, and that should take you very close to the YouTube page where you'll see some of my stuff. I also have, I know this is a long URL, but I have a spreadsheet that contains a list of all the videos I have, and you can click on that. I'll actually post that in the YouTube window. But thank you for your time today. I hope these tips have helped. If you're planning on improving your score, if you're trying to do whatever you can, just the best of luck to you. And thanks for your time, and have a great day.